10 loans retirees can consider after retirement in the USA. Did you know that retiring does not automatically mean you can no longer qualify for a loan? Many Americans believe that once they stop working and start receiving Social Security or pension income, banks will stop lending to them. But that's not necessarily true. Retirement income can sometimes be used when a lender evaluates your ability to repay a loan. However, approval is never guaranteed. Your credit history, income, debts, assets, and the lender's requirements can all matter. Today, we're going to look at 10 types of loans or credit options retirees in America may be able to use. And number 10 is especially important for homeowners age 62 and older. Fact number 1, personal loans. A retiree may be able to qualify for a personal loan even after leaving the workforce. A personal loan can potentially be used for things such as home repairs, large expenses, debt consolidation, or unexpected costs. The lender will generally look at your overall ability to repay, not simply whether you're currently employed. Retirement income, including certain regular income sources, may be relevant to that evaluation. But remember, approval, interest rates, and loan amounts vary by lender, so don't assume that receiving Social Security automatically guarantees approval. Fact number 2, auto loans. Retirement doesn't necessarily prevent someone from financing a car. A retiree may apply for an auto loan just like another consumer. The lender may consider income, existing debts, credit history, down payment, and the vehicle itself. For someone living on a fixed retirement income, however, the monthly payment deserves special attention. A car payment that looks affordable today could become difficult if property taxes, insurance, medical expenses, or other costs increase. So before taking an auto loan, look at the total monthly cost, not just the advertised payment. Fact number 3, home equity loans. If you own a home and have built substantial equity, a home equity loan may be another option. In simple terms, you're borrowing against part of the value you've accumulated in your home. The Consumer Financial Protection Bureau recognizes home equity loans as a form of consumer credit. But there's a major warning here. Your home is securing the debt. That means failing to meet the loan obligations can put your home at risk. So this isn't free money. It's borrowing against an important retirement asset. Fact number 4, HELOC. Another option for some homeowners is a home equity line of credit, commonly called a HELOC. Instead of receiving one fixed amount all at once, a HELOC can provide a revolving line of credit based on home equity. This can provide flexibility, but it also comes with risks. Interest rates and payment structures can vary, and your home is generally used as collateral. That's why retirees should understand the terms carefully before using home equity as a source of borrowed money. Fact number 5, reverse mortgage. Now we come to one of the most important options for older homeowners. A reverse mortgage is a special type of home loan designed for homeowners 62 and older. The most common type is the Home Equity Conversion Mortgage, or HECM. Unlike a traditional mortgage, the amount owed generally increases over time rather than decreasing. The loan usually becomes repayable when the borrower sells the home or no longer lives there, subject to the loan's terms. But there's a major responsibility. The homeowner still needs to meet obligations, such as property taxes, homeowner's insurance, and maintaining the home. Failing to meet those responsibilities can create serious problems, including possible foreclosure. So a reverse mortgage should never be viewed as free money. Fact number 6, mortgage loans and refinancing. Some retirees may also qualify for a traditional mortgage or refinancing. A lender may consider retirement income and other financial information when determining whether the borrower can afford the loan. The CFPB explains that lenders can evaluate whether a borrower's income, including retirement income, will be adequate for the life of the loan. However, retirees should carefully consider whether taking on decades of housing debt makes sense for their retirement plan. Fact number 7. Credit cards and credit lines. Credit cards aren't technically installment loans, but they are another form of borrowing that retirees may use. A retiree may continue using existing credit cards or apply for new credit if they meet the issuer's requirements, but this option requires discipline. Credit card interest can be expensive, especially if you carry a balance from month to month. For someone living on a fixed income, using credit cards to cover everyday expenses can become a dangerous cycle. Credit should ideally be used strategically, not as a replacement for income. Fact number 8. Loans secured by assets. Some retirees have significant savings or investments. Depending on the financial institution and the specific account, there may be borrowing options connected to certain assets. The basic idea is simple. Instead of relying only on employment income, the lender may consider the value of eligible assets or use them as security. But there is an important risk. If the loan is secured by an asset and you cannot meet the agreement, you could potentially lose that asset. So, retirees should understand exactly what is being pledged before signing anything. Fact number 9. Pension or retirement income-based borrowing. Some companies advertise loans or advances based on pension or retirement income. This is an area where retirees need to be extremely careful. The CFPB specifically warns that pension advances can be a trap and encourages consumers to understand the risks before using them. A quick cash offer may sound attractive when you're facing an unexpected expense, but always ask, how much will I receive? How much will I repay? What fees are involved? And what happens to my future retirement income? Never focus only on the amount of cash you receive today. Fact number 10. SSI and loans, an important rule. Here's a fact many people don't know. If someone receives SSI, the rules can be different from ordinary Social Security retirement benefits. The Social Security Administration says that if you enter into a valid loan agreement, the borrowed cash itself is generally not counted as income for SSI purposes. However, if borrowed funds remain unspent into the following month, they can count toward SSI's resource limit. For 2026, SSA states the general resource limit is $2,000 for an individual and $3,000 for a couple. That means someone receiving SSI should not assume that taking out a loan has no effect on their benefits. The timing and how the money is handled can matter. And remember, SSI is different from Social Security retirement benefits. Bonus fact: Social Security retirement benefits can be received while working. Here's another important point. Receiving Social Security retirement benefits does not necessarily mean you cannot work. According to SSA, you can receive retirement benefits and work at the same time. However, if you're younger than full retirement age and earn above the applicable limit, your benefits can be temporarily reduced. For 2026, SSA lists the annual earnings limit for someone under full retirement age for the entire year as $24,480. Once you reach full retirement age, SSA says your benefits are no longer reduced because of earnings, so retirement income and employment income can sometimes exist together. Final message. So, can retirees get loans in America? Yes, potentially. Depending on their financial situation, retirees may be able to consider personal loans, auto loans, home equity loans, HELOCs, reverse mortgages, mortgage refinancing, credit cards, asset-secured borrowing, certain retirement income-related borrowing products, and other forms of consumer credit. But here's the most important lesson. Being approved for a loan doesn't automatically mean taking the loan is a good idea. Before borrowing money during retirement, look at the interest rate, fees, monthly payment, repayment period, collateral, and how the debt could affect your long-term financial security. And if your home is involved, be especially careful. Your retirement years should be about financial stability, not creating a new financial burden you can't comfortably manage. If this video helped you understand your options, subscribe to Tyson Retires for more simple explanations about Social Security, retirement benefits, SSI, SSDI, and financial topics for older Americans. Remember, understand the loan before you sign the loan. This video is for educational purposes only and is not legal, tax, or financial advice. Always check the current rules and speak with a qualified professional about your individual situation.